Hey there, Dale.
Well, good morning. How are you?
I can't complain. It is Tuesday, and it's a better day to be doing a market update than yesterday.
Yes,
How are things for you?
yesterday was kind of tough.
Yeah, it was a little bit. Luckily, we bounced back from it. What we're talking about right here is this nice, tall, green mortgage-backed security candlestick. As you can see, red and down is bad. Green and up is good. We tested some floors of resistance yesterday. We broke through one of those Fibonacci levels, and we luckily bounced off of that one. But today, we're still kind of headed in the downward trend direction. It's just uncertainty in the market, and it's driving everyone crazy. But Dale, we were talking about this. It doesn't make sense that mortgage-backed securities are going down because I do remember the last administration's Federal Reserve Chair, Jerome Powell, who's still the current chair, mentioned something about inflation at 2%.
Yes, yes. Once we got inflation down to 2%, we would start seeing some rate decreases. And we have not seen that. And keep in mind, little known fact, Jerome Powell is an attorney. He's not an economist. But that being said, you know, inflation, you can see it's coming down month over January to February, month over month for the year is 1.7%. We are right at the 2% we should be to start seeing rate decreases, and we're not. In fact, as I discovered this morning through different research, that right now the Fed only has 2 rate decreases planned for the remainder of the year, which doesn't make a lot of sense because when inflation's high, rates are high to stem the cash flow. But now that inflation is getting under control, we really should be seeing better rates. We really should.
Right, and do keep in mind that these figures for April and potentially the next month in May, when we get it June 11th, we will probably see inflation be around the same point. Yes, this is with tariffs, folks. These are the figures even with tariffs. Our current month-over-month inflation is 1.7%, even with tariffs. So keep that in mind. The big question is, why aren't we going? Well, we kind of have higher rates, 6.81%. We saw it trickle up. We are going to expect this to come up even further from there. But the big question is why? Well, uncertainty is the big one. U.S. credit rating was actually just downgraded. I'll blast through this really quick. S&P Standard and Poor's actually downgraded from a perfect AAA credit rating down to a AA+. That was back in August of 2011. They cited politics. Was a very exciting election year coming after this, so we kind of remember it. But if we move over to Fitch, August 2023, this one's interesting because they cited fiscal deterioration and governance. I won't get into the politics of it, but this was the moment where the world was actually improving in their economy. After COVID, everyone was bouncing back, seeing great reduction in inflation, and GDP growth was phenomenal. But for some reason, the United States was still seeing record high inflation month over month, and we were having a lot of governance issues. So Fitch actually downgraded from the perfect AAA to a AA+. Now Moody's, they just downgraded this month, May 2025, a couple days ago, citing rising debt and a fiscal deficit. Just to paint the picture perfectly, the United States, in all of its budget, spends 13% of its budget on just interest for its debts. So they moved down from the perfect AAA rating to a AA1, which is the exact same as a AA+. They just use a different figure for the same exact rating. So
if you think about it, think if your household income, 13% of it was going just to pay interest. That's a big chunk.
It definitely is. And Dale, this marks the first time in the United States history that all 3 of these ratings are below perfect. Yes, since 2011 we've had two AAAs and one AA+, And then 2023, we got 2 AA pluses and 1 AAA. And now we're below. Now, granted, we did talk about this earlier. The United States, in the grand scheme of things, we still have excellent credit. This is still a very good credit score. But the truth is, this marks a real period of uncertainty, and that uncertainty is being genuinely reflected in the U.S. Treasury. The United States needs to generate more money. They're going to sell more Treasury bonds, and they're going to offer a little bit more moolah for people who actually buy it. So we're seeing U.S. Treasury bonds go up, and if you've watched our videos, this is a direct competitor to the mortgage market. And as this goes up, the mortgage market suffers. So that's kind of where we're at with all of this. If you're wondering why inflation's doing really well and we're not seeing inroads, this is why. So.
Yeah, it's extremely unfortunate, but as always, we're hoping for better things.
Right. And the stage is set. I can speak for myself. I think you have the same sentiment. Everyone else in the mortgage industry probably feels this way. We're looking around and we're wondering, every single thing for the party that is lower interest rates has been set. We have the plates, we have the forks, we have the knives, we have the confetti, we have the balloons in the ceiling, we have the fireworks ready. Everyone's got their finger on the trigger. We're just waiting for the moment where we can say party time.
Yeah.
So, all right. Well, Dale, that wraps it up for today. Greatly appreciate your time.
Absolutely. You have a great day.
You too. Bye.
All right. Bye now.